All right. Good morning, everybody. TGIF. This is a kind of a weird looking chart, but once you know all the pieces to it, it makes a little bit more sense. All right. So in gray is the SPX. It's kind of buried through everything. In pink is the SPX call wall year to date. So from January 3rd, 2024. In cyan is the put wall year to date. And the volatility trigger is the gold line. So what we've seen so far this year is price just working its way in between these two levels. And Spot Gamma was talking about how these levels have kind of shifted lower, and then they get brought back up, and they've shifted lower and they get brought back up. But if you look at what price has been doing, it really hasn't been that dramatic on either end. It keeps coming down to test that lower end. But otherwise, it just continues that drive to the upside. And yesterday, these three levels were all rolled up: the call wall, the put wall, and the volatility trigger, which they consider to be a very bullish behavior. We talked about that a little bit yesterday, how I considered it aggressive. It's just nice to get reinforcement of a concept or a belief, right? I believed it was bullish. Today they write about how, well, last night they wrote about how it was bullish. I like it, right? It's another validation of what we do. So I posted this in the Discord. You go in and read it at your leisure. This is last night's. I don't have the AM one yet. As usual, when I get it, I will post it in there. At the top, though, if you're reading these, it has this Spot Gamma index. Now, these are proprietary levels. You're not going to get them somewhere else. But you're getting them for free, because I'm giving them to you. But it doesn't just have, what's the Spot Gamma level now. It does give you a look back so that you can apply these onto the chart. It's a little bit of that nerd work, right? If you go back and lay out these Spot Gamma levels on your chart and look at what the S&P did when it had, a Spot Gamma level that was basically flat after having lost 1.9, or, where it was really high, 2.2, another 2.2, and whether it decreased like it did Thursday and Friday between the 8th and the 9th, or whether it increased like it did on Monday and Tuesday. So I just wanted to point that out so you can put those on your chart. Thinkorswim is good for that because you could put it on its own layer and then turn it off. But either way, it's a good read. Kind of get some ideas of what happened yesterday. And one of the things that really stood out, and I pointed it out yesterday, they also talk about it. The worst sectors yesterday: semiconductors, technology, the Mag 7, mega cap growth. If you're going to get a market rally, you kind of need those. If you don't have those, then they can't be negative, right? They can't be going down. So these were negative, but mostly flat, slightly negative, barely negative. The market really can't rally if these are going down. The market can't rally. If these are flat and kind of squishy and really not helping us, then the market can try to grind higher if it has enough broad breadth everywhere else. There's been numerous analysts that are talking about how this concentrated breadth is starting to broaden out into a lot of other places. This is just one more example of that. So something to consider. Next week is a short trading week. Will be market is closed on Monday, so I will not do a morning briefing on Monday. So something to consider. Inflation data out of the UK this morning gave them a bit of a lift, and we're kind of hoping to see a little bit of that last into our session, right? Sometimes we're bullish, we go into the close, it lasts overnight and kind of spreads out around the world. Other times, good data starts around the world and catches us by the time we get into the open. So kind of hoping some of this sticks. The NASDAQ is up 0.5% this morning. The S&P, not even 0.25%. And then the Dow and the Russell are both in the red slightly. Japan's up 0.25%, but really it's all eyes on Europe this morning. So we're going to get housing data. We're getting core PPI. We're going to have some Fed speakers, including Mary Daly. So full house, we got a lot of stuff today, but it's mostly all in the front end. By the time we get through with lunch, we should be good to go into the afternoon. Now, it's possible this Bank of England speech may cause some concern. The thing is, we don't know what this speech is about. So if you are worried about this afternoon, you're going to want to dig deeper into this, see if it's a pre-recorded speech or not, see if they're going to take questions or not. A lot of times that can solve your concern, right? Because if it's pre-recorded and there's no questions, then the likelihood that whatever this speech is going to affect the market goes down drastically. So it can really kind of free you up from those worries of, oh man, you know, it's got this dude's going to be speaking. I'm concerned. So if you are worried, that's what you would want to do. It's Bank of England pill and its speech this afternoon. It's close enough to power hour for me that I wouldn't be too concerned with it. Friday before a short week, that late in the day, I wouldn't stress on it, but you never know, right? So if it is a concern, just dig a little deeper. And really that's what we got for the afternoon. So I finally got some of my charts transferred on TradingView. This is the US interest rate right now. We're sitting at 5.5. If you think about what their target goal was, right? What was their stated goal? Is they wanted to get a little bit beyond the neutral rate, which is a hypothetical level that nobody quite knows what that is or where that is. But a lot of theorists subscribe to the idea that the neutral rate is somewhere just above 2%. So their goal was to get beyond the neutral rate into slightly restrictive territory and then hold that level and kind of soak up like a sponge all of this helicopter money that was dumped out during COVID. Between this and a correction in the supply chain issues, it was believed that they could get inflation back under control. It makes perfect sense, right? I mean, that's what their idea was. Some of the ways that they gauge whether or not they are restrictive enough is by looking at jobs. It's just a really simple metric to look at. So obviously, you know, it helps them out. The problem is looking at jobs as a lagging indicator and not by a little bit. It really lags. And if you keep track of the revisions that come in on those job numbers, they're constantly sneaking numbers in under the fence, not the headline numbers. So that makes it even a little more shady and wishy-washy. What you want to continue to start paying attention to are these headlines with layoffs of big names. The most recent one to date, Nike, 2% of its workforce. That's a big one. But it's just one more name in a string of names of companies that are laying people off. We're getting PPI this morning. This is the month over month. There's a 0 level here if we want to focus on that. You can kind of get an idea of where we were pre-COVID. And then, of course, what happened through COVID, through the bear market 2022, kind of the rebound, and through 2023, and then where we are now. But when I zoom out and we look at where we are now and how many times in history we've been this low or lower, not very many times, right? Now, this is a monthly. So we're able to go all the way back to 2011 pretty easy. Here's the year over year. It's more the one that's more in focus. So kind of bringing us back to January 2020. We're really close to that level again. We'll see what we get for the numbers today. It's that unemployment rate. Of course, I have to scrunch it up this way because, you know, the COVID situation. But if you look at where it was pre-COVID, we have a long ways to go in that regard. Non-farm payrolls, jolts. All right, so the volume's a little light, sitting at 72, and they are hedging. They're a little bit concerned this morning. Now, there's 3 opportunities every month for a liquidity gap trade play from the 830 candle. Even if we don't get the gap close set up, you can still use that candle for your analysis for the day. Doing analysis on an event candle can give you all sorts of immediate levels that are more valuable than the generic open, high, low close from yesterday, or the open, high, low of the week, something like that, right? Those levels are good, but measuring an event candle gives you all sorts of levels that you can immediately apply on that day's trading. And if we don't close the gap that day, then it gives you levels even into the next day and the day after that until we finally get those levels closed. You can use just a simple quant tool, but if you don't have that, you can use your Fibonacci and just add extra lines. The lines that you want is the half back, it's the 50% mark in the middle, 50% above 100, and then 100% beyond the original thing that you measured. So 50%, 100, 150, 200, you can measure it out as far as you want to go. So even if we don't get the gap close set up today, we still want to analyze this 830 candle. I tend to do that sort of analysis on the same time frame every time. The 5-minute. I don't really trade on a 5-minute, but most of my analysis on the intraday is using a 5-minute. The 5-minute open candle, the event candles like CPI, PPI, non-farm payrolls. I'll measure them and lay out the levels on a 5-minute, and then I go to whatever chart time frame I want. The idea behind that is consistency, right? If I measure it on a 1-minute this time, and then I measure it on my 3,500 tick chart next time, and then the 5-minute next time, then there's no consistency to it. So we're going to be looking for that 830 print to be impactful for today, and it could be the impact of the day. And when we get into the later part of the day today, continue to keep in mind that OpEx is happening today. You're going to see volume flows that are hard to read because they're rolling. Rolling will still hit the volume trigger. So it's going to show that there's volume. But if they're just rolling an existing position, they're not starting a new position, then it doesn't have the same weight or the same impact. So the volume is going to be a little odd. It always is on OpEx. But we have a market maker move. That's telling us that they're hedging in the front end. This isn't my opinion. I'm not guessing or assuming. They are hedging in the front end. We know this for a fact. They'll only hedge if they're concerned. Hedging is cost. I know there's a popular theory that we can, make money by using hedges. And sure, I mean, if you don't have a portfolio to protect and you use hedge tactics just to put a trade on, why not, right? You can do that. But generally speaking, when you have a large portfolio and you have to go get a hedge, it's nothing more than cost. We don't look at a hedge as profit. The same way that you don't get house insurance against a fire and then hope for a fire just to get some money, right? You don't want to lose your house. You don't want to collect that insurance just to get some money. And you certainly wouldn't call it profit. So their hedging tells us that they're a little bit concerned about these numbers that we're going to get. Normally, PPI is the lesser of the three events: CPI, PPI, non-farm payrolls. It's not to say that it doesn't matter, because it does. Obviously, it matters, or they wouldn't be worried and hedging. But out of the three, this is the least impactful statistically, historically, out of the three. So the fact that they're worried about it should give us a little bit of pause and, perhaps prepare us for the concept or the idea today that we could make some pretty good size moves. The S&P moved 2% this week. It's been a while since we've seen an intraday 2% move in the S&P. Now, we've seen it before, and if you're new to trading and you haven't seen it, we've had 7% moves. That's when we trigger lock limit levels. But we've had them, and eventually we'll get them again. So a 2% move might seem extreme if you've never seen one before, but it's just a drop in the bucket. I don't think we're going to get that kind of move today, by the way. I'm not wanting to make it sound like all doom and gloom. It can be a 2% move up or a 2% move down. And it doesn't even have to be 2%. All we know is that they're hedging because they're concerned. If the numbers come in muddy and they don't have a clear direction, they're going to kick it all to the nerds anyways. And then they're just going to sit back and wait for the nerds to tell them what to do. That's going to spread out how soon they all come back to trade it. And so we're not going to see that immediate offside reaction with the really big moves in each direction, in one direction. So there's no promise of a big move. The other thing about a big move day, and maybe you've seen this before, where a week in advance, everybody starts hyping it up. Oh yeah, this FOMC is the big one. The CPI, it's going to be a big one. It's the big one. They start hyping it up early. It becomes this bigger and bigger and bigger event. Everybody continues to talk about how big it's going to be, how far we could move, laying out measured moves and calculated expected moves. And then we get the event and it's one big candle with wicks on each side, and we pretty much close where we start. Why? Because somebody or enough people hedged it to the eyeballs to where it doesn't matter if it goes up or it goes down. They don't have to sell their position. They don't have to change their position. They're not caught off sides because they're not on one side. They're on both sides. What makes price move, right? Catching them by surprise when everybody's long and they all suddenly need to be short, or everybody's short and they suddenly all need to be long. When they're off sides, they all scramble and they're hitting the tape all at once trying to catch their trade, and market makes big moves. But if they're all hedged and they don't need to, and there's no offside because they're long and short, then it negates the big move that everybody's looking for. We have an MDP today, and we had one yesterday. Yesterday's counts for today. Today's will count on Monday if we can hold not going down there and hitting it. So here was the pivot point yesterday. We never got close. We got a lot closer today to today's pivot point, but hand grenades and horseshoes, close don't count. So that MDP from yesterday is today's register. And if today's doesn't get hit, we'll use it on Monday. It's bullish to hold above the pivot point without touching it. If you haven't gone through any of that material, it's not mine to teach. I don't trade it, by the way, but it is useful for analysis. You can just search MDP on the internet and or especially on YouTube, and you'll find some videos that kind of go into it in some detail. We did finally get our inside week breakout, first struggling at last week's close and then struggling with last week's high. We're finally outside of it. It's at 50.48. We're also inside day breakout, so we're outside of Thursday's high. That 50.50 level was a call wall, but it's now up at 50.65. This is a relatively tight range for the call wall and the put wall. It's almost like a squeeze event, and that's something to consider. Now we're going to see things rolled and moved today, so this squeeze style concept probably won't last, but it is still something to really consider. If we're looking for a big move, and we were just talking about hedging this thing, it would make sense that we see liquidity on each side, which is exactly what we have here. During the trading day yesterday, or even early this morning when they started to hedge, where would you put your hedges? On each side of the range, right? That way it doesn't matter which way it goes, you're covered. So with that in mind, we could go into the close today just holding inside of this zone. 50.65 on the upside and 50.10, 50.11 cog line on the downside. And that's it. That could be a wrap right there. But we do have the market maker move. So what we do with that is we want to take it and add it to the top line, and we want to subtract it from the bottom line on this yellow line here. So just a nice easy number, just round it up. It says 19.5. Round it to 20. We're looking at 50.95. That would be what, 51.15. It's easy enough. 51.15. That's one of our zero gamma levels, spot gamma levels. So we already had a line up there, and that's where that market maker move puts us to the upside. So, okay, we don't need a line there. We already have one. To the downside, round this down to 5,000 and then take $20 off of it. 49.80. It's all the way down here. All right. Not even to the 20-day moving average. Now, this is not saying we're going to go to 49.80 or that we're going to go all the way up to 51.15. It's not saying we're going to go there. Just that if we start to break down and we do get below that ADR full, what's the next measure to move? It would be that market maker move. And we saw this week where the ES was easily below that yellow line on the day, and it continued to expand to the downside. That 2% day that we had, right? Plus 2%. I am looking for a gap close play. Just remember, if we get wicks on both sides, then there is no gap close play. There just isn't one. We're done with it and we go do something else. So back here, this is an example of what we want to see. You get the event candle, you lay your lines and levels out in both directions from that event candle. And you look for price to get back there, usually by around 11 o'clock, right? We got there a little early on this one. But if it's a big candle with large wicks on each side, then forget it, right? Just like, never mind. All right, yesterday we talked about the narrowing 10-day, 30-minute volume profile from 26 to 66. Well, 49.26 to 50.66. It's a pretty tight range for 10 days. Throughout the day today, we're going to lose a little bit more off the bottom here unless we can break this low from earlier in the week. That's a 2.5% move. 2.25 basically from our current location. I mean, we can do it, but we would have to get some really bad numbers. Otherwise, we're going to look to expand to the upside through the top. We can use some measured moves on that, but we already have our levels laid out. By the end of the day today, unless we move to the downside, we're very likely going to see this point of control move up. It'll happen whether or not we stay at these two levels. So if we, break to the upside and continue to run, this point of control is going to come up to 50.11 basically. And it'll take another week or so before it moves from that spot. So it's kind of thinking ahead of where the next level is going to be. So yesterday we did get into the VPOC. We don't get enough opportunities to demonstrate what we're looking for when price comes up and hits these levels. I call it a first touch play, right? It's not the idea that we're expecting some massive beat down at that level that we're just going to fall and fall and fall. But it very often can provide a first touch rejection. In this case, it gave us a swing high and set us up with a distal and proximal line and a liquidity zone that we then needed to see price work its way through, which was a big focus, right? We just sat there digesting that. So that's kind of what we're looking for with that VPOC. Now that we've hit it, though, we're done with it. We have a new one from yesterday. Yep. 5023. So if we do make moves to the downside today, we got that new VPOC down there. If we kind of take a bigger picture of what we got, a stack of them, right? We got quite a few down there. It's interesting to note the amount of volume up at this level, that 50-53, right? I'm pretty sure that is just above that weekly pivot. Either way, we spent most of our time down here this morning. And yet the point of control for the volume is up here. Because after we got that inside day breakout and we got outside the previous week's high, we seem to have found a bit of a ceiling. All right, so we know next week is a short week. And even though these ranges aren't set in stone until Friday afternoon at 4:15, we can kind of get an idea of what they're doing with the volatility early. So we measure the week that we just had and we lay it on top of the new week and we ask, what's the volatility looking like for next week? A short week, by the way. Now, if you are measuring something that has 5 days and then you compare it to something that only has 4 days, that 4-day thing should automatically be smaller just because it has less days in it. And especially when you're talking about volatility. How far can price travel in 5 days compared to how far can price travel in 4 days? That's like asking how fast can your car go if I give you 5 minutes, or how far can your car go if I give you 4 minutes? Right? It's kind of the same analogy. Your car's going to not go as far in 4 minutes as it could go in 5. So why is next week's range bigger? It's got a higher volatility. What is in next week's econ? NVIDIA earnings. That's it, right? That's the biggest thing once we get through OpEx today. The next biggest thing, NVIDIA. NVIDIA's earnings are so anticipatory that it literally is reshaping the volatility levels in the entire marketplace, specifically the S&P. So to say that next week's NVIDIA earnings carries some weight, yeah, I can agree with that. We're still more than 3.5% above the 10-week. We're not in uncharted territory, but it's rare to get higher than this and stay there for a long period of time. We had something like that by the end of the year when we just got up there and was waiting right into that December high. But otherwise, when we get above this 4.28 level, we tend to just spike up into it and fall right back out of it again. And we're on the decline from that level anyways. We didn't even get beyond that. So today's going to have a lot to do with how this looks next week. If we get above this last high that we made, which has happened before, right? Like back here, we set a high, pulled back, and then we went higher. Same thing here, pulled back, went higher. So it's certainly happened before. That's what we want to be focused on. We're still not overbought. We haven't moved too far, too fast. We're getting into the edges of that, but we're not there. Not on a weekly, which is that bigger picture. How much more room do we have? Plenty of room. Put it on a daily, and you can see we're not even at 1% yet. We're not even 1% away from the 10-day moving average. So we haven't moved too far, too fast. It doesn't owe us a pullback here. On average, over the last, well, let's just say just for this year, we're in that pullback zone. 1.3% is kind of the topping out level, just year to date. But when we start bringing in more data, even 1 year's worth of data, then we can see that we get higher than this frequently. So we kind of talked about that blue line earlier in the week and last week, how far away from the 10 we get before we take a rejection. We kind of go in stages, or we run in averages. Back here, we were expanding beyond it a lot. And so that blue line eventually got up there. It's a lagging line considerably. But we're holding this level long enough that we're almost in line with that blue line. So lagging or not, they're finally catching up with each other. Want to see if we're going to continue to expand here or not. Now, on a day like this, when it's all focused on one single event, you can try to go in and take a look at, the names that are up this morning. But you're not going to get very far. And I found that it's generally a waste of my time, right? We've only got so much time in the mornings to get ready for the bell. And if we look at a bunch of things that are up and start making plans, and then PPI comes in and everything that is up is suddenly down, then we wasted all of our time for nothing, right? You're better off letting the data come in at 8:30. And then if it's bullish or bearish, then taking a look at the stocks that are up or down and how they responded to that PPI. Otherwise, without it, what do we have this morning? We have semiconductors up, the China ADRs, the Mag 7, and Bitcoin. A lot of that is what was down yesterday, right? The Mag 7 was down, tech was down, semiconductors were down. So it makes sense that we're getting a little bit of a mean reversion from those. Bitcoin has been up, continues to be up, and so does all of the proxies. So they're kind of doing their own thing and just marching to the beat of their own drum. You could look in that direction, since they might very easily ignore PPI. Everybody, be careful, be safe, have a good weekend, and I will see you all Tuesday.